Good evening, everyone. Time for another silver update. You're looking at the 8-hour chart of silver. We had a fairly nice rally today. Not anything serious price-wise, but a nice technical turn. I've drawn a number of lines here. First, the primary trend line. You can see we haven't tested that, but we're now turning around and rising. We've got a now rising MACD on this 8-hour, and I've drawn a flag formation of how we're shaping up here. If we go the way I expect, we'll probably rally here and go something like this maybe. The other lines are peak volume tops that I've delineated here with these lines down below, two of them, which correspond to these rising lines. As I pointed out in the past, the volume surge, as long as the price is continuing to move above the average price where the volume entered, is bullish. So you can see that our correction here and our correction here did not go below the volume spike here, and we've now got a minor volume spike. We tend to get rising prices on descending volume, and we have sell-offs on massive volume. That's to be expected. That's the pattern that we've maintained for quite a while. Slow accumulation by the longs, and then outright devastation by the shorts. So although we had a tremendous sell-off here and a small sell-off here, we haven't really punctured the technical picture, and we're still in a rising market. So I wanted to pull up a cross chart here to point out a little interesting formation that we're seeing. If we do an overlay of silver with oil, I may have to pull this out. I'm going to go ahead and use the relative chart for silver. I'm sorry, the overlay. And what you can see on this chart is an interesting divergence. Oil sold off quite dramatically from about $100 down to $75. So that's a 25% haircut we got there. As you know, gold rallied, did something more like this, and you can see silver is held fairly steady. Now, the trend of silver and oil are pretty steady. So one could argue, and they do argue, that the reason why silver has failed to rally with the latest market sell-off the way gold rallied is that silver is more an industrial metal and therefore is affected by economic downturns and slowing of the economy. What's interesting is this divergence that we have here. This is definitely the largest divergence we've had in a year, and possibly even longer. We'll pull back to the daily, and you can see it's still quite a divergence. Silver has not fallen to the extent that oil has fallen. Now it looks like oil is rallying back strongly, and I just can't see $75 oil. So we'll have to wait and see how this works out. My guess is this will probably resolve itself to the upside, something like this, and they will probably join back together at some point in the future. And I wanted to jump over to the numismatics real quick. There have been a lot of comments about my series on numismatics. I think a lot of people don't really understand where I'm coming from. A lot of people have made arguments about how when silver price goes very high that the numismatic price won't matter that much. I actually agree with that. I believe that at some point when the silver price goes astronomically higher, that the premiums on the numismatics will compress, and obviously at some point a numismatic coin will probably be worth roughly what a round is worth when silver is, say, $1,000 or $2,000 an ounce. Probably won't be much difference. That's not the time frame that I'm looking at. I'm looking at more of a intermediate time frame. Now, I wanted to point out that I can't say that it's due to my video update, but you'll notice, and a number of listeners have pointed out, that all the coins I pointed out on Gainesville and on APMEX are gone. And that's pretty dramatic. There weren't that many, but you can see that the selection on Gainesville for the Perth Mint selection is really small. You've got the mouse is still available for 46, and the rabbit is still here, but it's 61. So if you remember in my previous videos, there were boxes and boxes and boxes of these coins. You'll have to go back to previous videos, but you had tigers in boxes, you had koalas in boxes, you had kookaburras in boxes, you had just a huge amount of coins available, and there's really nothing available left on Gainesville. So a clear indication of the tightness of the market. The same thing is visible on APMEX. So the market continues to tighten for these coins. I think that's a clear indication that the buying in the silver market hasn't let up at all. In fact, is accelerating. So I wanted to take a little bit of a different tack on this episode and talk a little bit about trying to get the most silver for your money. Now, a listener has asked me about the Olympic, well, it's not the Olympic, it's the, it's the America the Beautiful coin, and I'm looking at these over at APMEX. These are 5-ounce coins. Now, if you remember when they came out, there was a huge hype. These were being hyped by various, I won't say bullion sellers, but more secondary numismatic or collector sellers, and at one point the pre-sale price of these was astronomical, but possibly partly because of that pre-release hype or just because the interest waned. I'm not really sure why the prices have collapsed the way they have, but the prices have pretty much collapsed. You can see you've got these series of coins that are based on these national parks. You've got the Chickasaw one, you've got the Vicksburg one, and the one I really wanted to concentrate on is this Olympic National Park. Now, this is a 5-ounce coin, and you can get it for $208, so that's just a little bit above $40 an ounce. So I can't really see how you can go wrong with this coin. You're really not paying anything more than you would for the cheapest rounds, and you're getting, well, this is a coin you're getting. So it's obviously a beautiful coin, and it's very well made, and probably will at some point be a collector's coin, but right now it's pretty much going for the price of bullion. Now, I'm not really sure why that's the case. Again, it might be the pre-market hype that occurred. It also might be the unfortunate face design that we have on the front of the coin. It's based on the Washington quarter. What's really strange is it's denominated as a quarter dollar, so it's not like the Silver Eagle where it has at least a semi-reasonable value to it. This is a 5-ounce coin valued at a quarter dollar face, so I don't know why they chose that. I think that this Washington quarter symbol is probably, or design, I'm sorry, is probably harming the coin, but the other side is an excellent relief of the Olympic National Forest, and if we get a dip, I'll probably be interested in picking some of these up. You can see there's quite a few available They have 3,900 of these available, and that's a large amount. That's about 20,000 ounces of silver they have here. So this one I'm going to highly recommend for those that aren't into numismatics, because this is kind of a double play here. You might actually get some kind of numismatic pop later on, but you're basically getting the cheapest round you can get. So I highly recommend this coin. You really can't go wrong with this. I wanted to jump over to a couple of articles I wanted to cover tonight. The first one is an article that was covered by Zero Hedge, and then this is the original article here. It's called The Mechanics of Financial Repression. It's by Daniel Ammerman, and it's a very enlightening article. It basically goes into the strategy of the Western governments, the way they walk the tightrope between a deflationary default crash and a hyperinflationary blowout, and their strategy for basically shearing the sheep. And so he outlines the 4 primary strategies that they use: inflation, negative real interest rates. If you remember, in my rate scam video, I talked about how the interest rates are set and how they're manipulated and how they're actually robbing savers. And involuntary funding and capital controls. So I wanted to read a snippet of this. It pretty much summarizes where he's coming from. The governments of the world are in trouble, and they would prefer to avoid overt global defaults, hyperinflation, or comprehensive austerity coupled with massive tax hikes. Each of those routes is highly unpopular and could lead to political turmoil that would remove the decision makers and the special interests who support them from power. A more overt, managed economy sounds much more attractive if you are in power, particularly since it has worked before over a period of decades with an almost boring lack of political turmoil. To get out of trouble, the governments have to wipe out most of the value of their debts without raising taxes to the degree needed to pay the debts off at fair value. In other words, they need to cheat the investors. There's nothing accidental going on here. All that is in question are the particulars of the strategies for cheating the investors, meaning the collective savers of the world. Again, the time-honored and traditional form that governments who incur too much debt use in cheating the investors is to devalue the currency. Create enough inflation and tax collections will rise with the inflation, but debts won't, and the savers of the world will be paid back in full with currency that is worth much less than what was lent to the governments in the first place. Except that there is the technicality that in theory interest rates will rise above the rate of inflation, so that the value of savings is not eroded. From the governmental perspective, this is demonstrably a rather absurd theory. The core point of the Reinhardt and Sabrancia paper is that the advanced economies of the world quite effectively squeezed an average of 3 to 4% annually of the value of government debt out of investor real net worth for a period of 35 years, using a wide assortment of overt and less overt controls over interest rates and investor behavior. Today, the mechanism is different in that the central banks are using massive monetary creation in combination with their regulatory powers over major banks to control interest rates. However, the bottom line is that interest rates are absurdly low compared to the inflation and default risks. And this is because of near complete government control. One potential sheep shearing problem is that only a minority of us sheep directly own government debt. For maximum sheep shearing efficiency, all of us who lead productive lives and produce more than we consume, meaning we generate savings, need to be sheared, and sheared often. Whether we buy government bonds or not, this next step is one of the hardest parts for non-financial professionals to understand. but through manipulations of capital requirements and creation of regulatory incentives and disincentives that never make the non-financial media, governments can effectively control the investment behavior of financial institutions and force the institutions to take on investments that pay less than the rate of inflation, from which the institutions still take their cut and then pass through a still lower real return to the depositors and policyholders. So wherever we put our money, in whatever financial institution, we get absurdly low rates of return that help the governments reduce the real value of their debts. So we're getting sheared. We've got no choice about it. The government explicitly plans to keep on shearing us for every remaining year of our lives, and wherever we go in the meadow, we still get sheared. This leads to the more savvy of us sheep trying to escape the meadow. And again, this is anticipated in the financial repression structure right from the beginning. With the construction of capital control fences, many of the control on savings leaving the country have been loosened since 1980. However, these controls have been returning since 2008 and are just likely to grow stronger as the return to full-on financial repression likely grows more overt. It's an excellent article. I'm going to go and link that. Now, of course, he goes to Leaving the Flock, and there's actually some sign-up things to do, but we really know that this is Leaving the Flock. Gold and silver investment are the two ways that the sheep can leave the pen and actually benefit from the inflationary policies that the governments are pursuing. I pointed out in my last video how the price of gold is rising in all currencies except the Swiss franc is in new highs against all currencies. So that's happening right now. I think more and more sheeple are understanding what's going on. I think silver is probably late to the party and is going to explode to the upside once the game begins to be exposed. And the last thing I wanted to read is the most recent article by Ted Butler, and I don't usually read Ted Butler. He's been fairly staid in his analysis. I don't know what set him off, but in this latest one he really lays it on the line, and it's just a fantastic short article, so I'm going to read it to you. Here's an excerpt from an update sent to subscribers on August 10, 2011. For subscription information, please go to butlerresearch.com. It is important to try to understand as much as possible what are the dynamics behind the large price moves recently. It is human nature to accept any plausible sounding reason offered if it is in conformance with the price direction. In a big price move, we demand an immediate explanation, and then we accept any explanation offered, even if it doesn't stand the scrutiny of further analysis. For instance, big price declines in copper and crude oil are immediately explained and accepted as being due to weakness in the world economy. Yet we know that the world economy and copper and oil fundamentals can't possibly change quickly enough to be the real explanation. Please allow me to offer what I think is the real cause behind all the crazy price volatility, and then to suggest something constructive you might want to do about it. What's behind the volatility is unbridled speculation and computer-type HFT, trading gone wild. Oil didn't drop $20 a barrel or copper 25 cents a pound because there was a sudden fall-off in demand or increase in supplies. This was all about speculative trading gone haywire. Let me be more specific. The whole premise of the economic justification behind the commodity futures trading has been bastardized. U.S. law has sanctioned the trading of commodity futures for the express purpose of allowing legitimate producers and consumers, let's note this here, legitimate producers and consumers to hedge or transfer their price risks to speculators. But the wild price swings we are witnessing are not related to legitimate hedging. The volatility is a result of speculators battling speculators, with real hedgers largely on the sideline. This is relatively easy to demonstrate. The big price moves are the result of moving averages and other technical signals being violated. Technical funds and other momentum-type traders rush into and out of the markets, often on an intraday basis as a result of these price changes. Against those technical-type traders are aligned the commercials that take the opposite side of these transactions. But these commercials are also speculators and are not the legitimate hedgers they purport to be. Real producers and consumers don't hedge based upon changes in moving averages and on a daily basis. Real hedgers don't day trade. Real hedgers don't engage in high-frequency trading. The fact is that commercial traders are just trading against the tech fund speculators, and this makes the commercial traders speculators as well. This is an important distinction. It is why the big commercials in COMEX Gold may be in trouble. Namely, they weren't hedging in the first place, and their short speculation may have been a serious miscalculation because it wasn't a legitimate hedge originally. If my analysis is correct, then most of the volatility is due to one giant, sick game of unbridled speculation. The speculators include not just the obvious and visible speculators, but also the commercials pretending to be hedgers. These commercial speculators in drag include the largest banks like JP Morgan. How has it gotten to the point where our insured deposit-taking institutions are among the biggest speculators? This speculative trading activity on the part of banks has greatly increased the current price volatility and increased the dangers of systemic risk. How is that good? We've gotten to this point because our financial system structure has encouraged more and more speculation on the part of our important financial institutions. Leading us on the way to ruin is the criminal enterprise known as the CME Group, which has become dependent of encouraging more of the mindless daily speculative trading to fatten the bottom line. So harmful is the CME's role in all of this that in order for the CME to be blessed, the public must be damned. What can we do about this sorry state of affairs? Quite simply, what we have been doing, namely, to petition the regulators to enforce the laws governing manipulation and disruptive trading practices. I know that many are tired of petitioning the CFTC because there has been little visible response from them regarding the silver manipulation. Yet I'm still convinced that this is the best and perhaps only constructive route. I'm not going to beg you to contact them if you feel it's a waste of time. Likewise, I'm not going to promise you that the agency will do the right thing, as that's up to them. All I do know is that silver is manipulated by virtue of a concentrated short position on the COMEX, and that is against the law. You must always do what you feel is right, regardless of how it may turn out or how many times you tried in the past, or whether someone else will also do the right thing. I know I'm going to send this article to the CFTC as well as to the CME and JP Morgan. I invite you to do likewise if you're so inclined, or write your own words and ask them to break up the concentrated short position in silver. I would ask that you remain respectful if you do write, so as to not distort the intent of your message. I know most of us are sick and tired of the silver crime in progress and the regulators' failure to deal with it. But you must rise above your emotions to be effective. Ted Butler. And he lists Gensler, Dunn, Chilton, Summers, and Amalia. So, a very emotional article by Ted Butler. I don't happen to agree with him. I don't think that the silver price is going to be impacted by the regulators, because I think the regulators are fully captured. In fact, I don't have any doubt in my mind about it. So, obviously, I believe that the defeat of these manipulators will be through the market, through supply and demand, through the offtake of physical silver. So I would encourage you, and I'm quite encouraged by the impact that I've had, encouraging people to buy numismatic silver. In this case, I'm recommending this Olympic America the Beautiful coin, and This is a double win. You can't go wrong with this coin. It is numismatic and it is cheap as bullion. And I'll be watching these numbers. Hopefully people will pick up these coins and start to sock them away, and we'll just go forward and take the physical off the market and force their hand. And we'll talk to you next time.